Which way is up? As the Fed talks taper, COVID keeps growing, and a debacle 7,000 miles away consumes Washington. This is Bloomberg Wall Street Week. I'm David Westin. This week, special contributor Larry Summers of Harvard on the biggest risk facing investors today.
I've learned that more often what gets you is what you're not worried about, than what gets you is what you were worried about.
And John Rogers of Ariel Investments on why slow and steady wins the race.
We would think it's a time for caution, a time for conservatism, and if you're going to be buying, to buy the value stocks that are still undervalued.
It was a week marked by uncertainty leading to indecision. Uncertainty over the economy as retail sales fell more than expected, and the resurgent coronavirus raised more doubts about whether we can continue to reopen the economy fully.
The uncertainty is something you got to think through. You got to think through the tangential impacts of a lot of this.
Uncertainty over how quickly the Fed will taper its bond buying, after minutes from last month's meeting showed at least some members want to get going before the year is out.
Markets have been well prepared for tapering. I don't think it will come as a surprise.
And uncertainty over whether a crisis caused by American withdrawal from Afghanistan could make it even more difficult for the Democrats to get their spending package through the Congress.
This is certainly a bad day for Joe Biden. Any momentum he had, I think, took a huge bump in the road.
And the markets this week reflected much of that uncertainty by being somewhat indecisive. Over the week, the S&P 500 was down a bit, but that was after it was up on Monday, way down on Thursday, and then recovered on Friday. Small caps took a hit, but again, not in a straight line, with losses on Tuesday and Thursday partially offset by gains on Wednesday and Friday. Treasury yields remained stubbornly below 1.3, and commodities were the one asset showing real direction, with oil down consistently through the week. To give us an investor's perspective on these indecisive and slightly nervous markets, we welcome now Catherine Keating. She is CEO of BNY Mellon Wealth Management. Catherine, thank you so much for being with us here on Wall Street Week.
Thank you, David. Happy Friday.
Happy Friday. So give us a sense of what you learned, if anything, through this somewhat tumultuous week.
Yeah, so I think the word I would use to describe this week, David, is moderating. Moderating. We came off a quarter of just torrid earnings growth, right? 90% earnings growth. And now we're looking at the economic data to try to figure out what the future holds. And as you said, we saw declines in consumer confidence, declines in retail sales, declines in the mortgage market, right? Modest declines in the mortgage market, which has been very strong. On the other hand, we see corporate America continue to do well, industrial production up. So, things are moderating, and that's normal at this point in the cycle. That's normal at this point in the cycle. You can shut down an economy all at once, but it opens in an uneven pace, and I think that's exactly what we're seeing. And investors are looking through that and looking ahead.
Well, that's my question. What are you hearing from customers? What are they saying? Are they nervous about this? Are they pretty sanguine? They think it's all going to come out okay?
One of the things I think that we have learned through this crisis is how quickly things happen, how quickly a virus spreads around the world, how quickly you can close down the economy, how quickly the market can sift through all that information and react, right? We had a 6-week bear market, and the market completely recovered in 6 months. So they're learning to sift information very quickly. One of the other pieces of information we sifted this week was the news about the coronavirus and the need for booster shots, right? The market's weighed that, understanding it, is looking forward. And again, the market always looks forward a few quarters. And looking forward, we continue to think the economy is healing. We're growing at a 6% rate. That's 3 times what we were growing at before this crisis. And we think there's a lot of support for markets.
Catherine, on Wall Street, we talk a lot about investors. Let's be a little more precise about who these investors are. You pointed to a piece on the Bloomberg actually this week about Fidelity, which reported that the number of 401ks went up something like 85%. The number of IRAs went up 75% of people with $1 million or more in them. Is there a fundamental shift coming in who these investors are, that is retail versus institutional?
And that is exactly the right question, David, because the structure of the markets has changed during our lifetimes. Today, the retail segment of the market, the assets that are governed by individuals, is larger than the institutional segment, and it's growing faster. And there's a reason for that. corporate America has fundamentally changed the way we save for retirement. Our parents' generation, they probably had a defined benefit plan, they retired with a pension and annuity for the rest of their lives, and their personal savings. Today, we save for our retirements ourselves. If we work for a great company, we're lucky to have them contribute as well, but it's defined contribution plans, it's 401k plans, and our personal savings that make us ready for retirement. So that's why you see this happening. I think one of the interesting things about that story is it does show the power of investing over the long term. The average age of some of those folks with the $1 million accounts was 58. So it shows the power of investing over time in markets that do go up over time.
So to put it very bluntly, do we know what we're doing? It sounds nice to take control of our own retirement benefits. At the same time, when it was our pension plan, we sort of thought there were professionals doing what they were doing.
Right.
I'm not sure I'm as good as those pension people are. Does it change the way that the market performs?
Yes, it does. So yes, that pension plan had professional management. It had a chief financial officer. It had a chief investment officer running it with very clear institutional disciplines. How much do we have to earn? What should our asset allocation be? How much do we have to pay out to our retirees? Very, very disciplined, very mathematical. There's nothing that requires us to do that ourselves. There's nothing that requires us. We have to embed that ourselves in what we do. And that's actually quite a mission for us in the wealth management industry, because consumers are 70% of the economy. We want them to have very solid financial futures, very rewarding retirements. And so we're trying to embed all of those institutional disciplines right into wealth management.
Does it make the market more volatile?
It can make the market more volatile, yes, because retail investors, again, over half of the market growing much faster. And retail investors tend to be more momentum-driven, more pro-cyclical, right? We've seen this with the Robinhood trading and all of that. Institutional investors tend to be counter-cyclical. And what does that mean? When the market goes down, what does an institution do? It buys equity. It rebalances. Nothing makes an individual do that, and yet it's one of the most powerful things you can do. Powerful things you can do, the whole power of compounding, staying with the equity market. And so if we look at last year, we can look at retail fund flows, we can look at mutual fund flows, we can look at ETF flows, and what we saw was in a year when the market was up, 18% over the course of a year, individuals were not net buyers of equities. They were net sellers. They were net sellers, which means they missed the chance for a lot of that rebound in the market.
Yeah, I think it's that old Warren Buffett adage that you want to buy when other people are selling, you want to sell when other people are buying.
That's right.
And a lot of our human instincts are the reverse.
They are the reverse.
The party.
They are the reverse, and in fact, behavioral finance tells us why. We love the euphoria of a gain, but we feel the pain of a loss even more. We feel the pain of a loss even more. So part of our job as a wealth management firm is to help our clients take the emotion out, behave like an institution. Our job is to help them do that.
I'm not sure how many of us individuals are paying attention to the Fed, but a lot of the institutional people are. We will next week be paying attention in Jackson Hole, which is now going to be virtual, it turns out. They're not going to actually get together in Jackson Hole. What are you looking for to come out of those meetings?
So I think we're looking for two things next week. One is, of course, Jackson Hole, and we look forward to Chairman Powell's speech on Friday. We'll be very interested to see whether he talks about tapering. He may not. He may wait a week and get the jobs report the first week of September. So he might not message anything very clear about tapering. We also are looking at the PCE inflation indicator that comes out next Friday, right? The Fed's preferred measure. CPI, the rate of increase of CPI came down. That will probably come down too. That's an important data point. And so we're really looking at those things next week.
So like the Fed, we all are looking at inflation and what they can do to investments. How concerned are you, as you invest money, about protecting against inflation?
So we watch inflation very carefully because inflation on its own doesn't end an economic cycle, but raising interest rates does. And we see the multi-trillion-dollar question is about transitory, and we do see signs of transitory inflation. We see commodity prices coming down, for example, already. And our base case is that inflation is transitory. It may be transitory to a slightly higher level. Right? If we think about, the decade since the financial crisis, inflation has been below 2% during that decade. But if we think about most of our careers, our investing lifetimes, the 1990s and the period up to the financial crisis, inflation was between 2 and 4%. And markets did just fine with that. So if we're transitory to a slightly higher rate, maybe it's 2.5%. markets can do just fine with that. You can raise prices a little bit, you can raise wages a little bit, consumers can buy a little more. That can be just fine.
Okay, thank you so much. Really great to have you here in the studio. That's Catherine Keating, and she is the CEO of BNY Mellon. Coming up, Greg Fleming of Rockefeller Capital Management is here on where high net worth individuals are putting their money in a low return world. That's next on Wall Street Week on Bloomberg. This is Bloomberg Wall Street Week. I'm David Westin. Investors of all sorts struggle these days to find yield and places where they can get paid for the risks that they're taking. Greg Fleming is president of Rockefeller Capital Management, managing assets of some $75 billion. At least that's the last time I checked. And it's his job to find those opportunities that aren't quite so obvious, especially for high net worth individuals. Rockefeller grew out of the family office of John D. Rockefeller, the oil magnate. And we welcome Greg now to Wall Street Week. Thank you so much for being with us, Greg. It's a big shoes you have to fill there with John D. Rockefeller. But give us a sense, as you talk to these high net worth individuals, what are they looking for and where are you finding it?
It's good to be here, David, and good to see you. David, our clients are primarily high net worth individuals and families, and even into the ultra high net worth category. And we work with them through private wealth advisors that deal with the client and their investment needs in the near term, all the way through to retirement, generational planning. So we take a long horizon with our private wealth teams. And when we look at the world today, given, as you said, you set it up well with a low rate environment, and if anything, rates are going to go higher from here. You have equity markets that have both volatility, and they have been on any historical measure pretty fully priced, particularly in certain parts of the equity markets. So what we counsel our clients on, given that they can handle the illiquidity that comes with alternative investments, is to put a portion of their assets with best-in-class alternative managers across a range of different investment strategies. And sometimes that even extends to investing directly in companies that are doing capital raising rounds on a direct basis. So we think for high net worth and ultra high net worth investors, it's important to have a percentage of their assets in alternative investments through best-in-class managers. We spend a lot of time researching different managers and different strategies, and then our private wealth teams bring those investments to our clients.
So, Greg, just educate me on this. When I hear alternative investments, I think I'm giving up some liquidity. Those tend to be things where I have to commit some money for some period of time, sometimes for a long period of time. Is that right? And if so, what's the trade-off there, particularly in uncertain times when there's a fair amount of volatility?
They do tend to be more illiquid, and the investment horizon is often longer, certainly than a publicly available security, whether it's a stock or a bond. So there's no question that that's what you're giving up when you move into alternative investments. But those investments then are made, whether it's a private equity manager or even a hedge fund, they tend to be made with a longer term investment horizon in mind. It allows the investor to access these managers who are investing through the cycle, if you will, David. So we think it's an important additive part of an investment plan for high net worth and ultra high net worth investors who don't have to access the full range of their portfolio on a real-time, near-term basis.
So Greg, at Bloomberg here, we had an interview this week with the head of the Norwegian Sovereign Wealth Fund, who manages a fair amount of money, I think it's fair to say. I believe it's the largest in the world. And what he said was he thought the biggest threat to his portfolio, and that's on the fixed income side and on the equity side, is inflation at this point. Do you agree with that? And if so, how do you take that into account as you make investments?
You know, I think that inflation, and he's probably, what he's doing is he's saying inflation, which will ultimately lead to higher rates, is the threat to his investment portfolio. And this is why the Fed is working hard to thread this, David. They wanted some near-term inflation here for multiple reasons, including trying to avoid the deflationary trap that Japan has struggled with for so long, and to get some pricing power in the hands of companies. So they wanted, and they've hung with this, I think, for some time to get some inflation in the system. But if it goes too far and if it becomes something, and people forget that inflation is also about expectations. And earlier in our lives and careers, there was more inflation. And when there's a sense of inflation, if it starts to get built into the system, then it does tend to be harder to move. And also, if you factor in the increase in home prices and home price sales for existing homes over the last year, you've had real inflation in the economy. So he's looking at it and he's worried about the fact that if it gets ahead of the Fed and the Fed has to start raising rates, that's obviously difficult for fixed income investments, but it also tends to a rising rate environment is a harder thing on equity markets as well. So that's why he's saying, wait a minute, if inflation starts to move and if it gets ahead of the central bankers and interest rates follow, which they will necessarily have to at that point, that could be problematic for both sides of his portfolio.
Greg, as you make the investments on behalf of your clients, do you have to make some rough projection, at least, about when the Fed will raise? And if so, what are you projecting at in 2022, 2023?
We spend a lot of time looking at that because it factors into near-term tactical as well as longer-term decisions. Our view, and my view, is that the Fed has hung in here for the reasons I described, resisted moving to tapering, and obviously hasn't done anything on the rate side because they wanted to ensure that they got some inflation in the system. I think, given the relative risks here, they're about to move on tapering. I do think they're watching very closely these jobs reports. So if you have another strong job report coming up and they think the economy continues to heal and to move forward, they will absolutely begin to taper. Because they have another problem too, David, and that is that if it gets a little ahead of them and they have to start raising rates in 22 sooner than they're currently targeting, you have a big federal fiscal challenge because if rates go up by 200 or 300 basis points and return to even levels where they were before the pandemic, you're going to be looking at interest service on the federal debt that starts to approach $1 trillion a year. That's another thing that's boxing them in on the other side. They're very cognizant of that challenge. So I think they're trying to find the middle ground here, and they have you've heard many commentators and economists say they should have been reducing, start tapering sooner than they have. I think they've held to this point, but they're going to turn to tapering in the near term.
Greg, to what extent do you take into account political risk as you advise your high net wealth individuals? Certainly this week there was a lot of talk about it with respect to specifically China, because China took further actions against various, they started out with tech, they moved into media, now they're doing it consumer products issues, and then we have the SEC saying we're not sure we want you listed here. So to what extent do you have to take that into account? Some people think China might not even be investable right now.
Well, here's what I'd say. If you go back to post-World War II, 1960, let's say, the U.S. GDP was 40% plus of the global economy. So, nearly half of global GDP was the United States. Today, it's closer to half of that, and it will continue to decrease as a percentage of global GDP going forward. So investors need to think about investing outside the country. There's no question. Now, there's a risk return on that. And you got to factor that in, whether it's a specific market like China or how much of the portfolio will be invested in different emerging markets. So that's always at play when we're counseling our clients. And that, is going to be part of the analysis for many years. I mean, China at some point over the next 5 or 10 years is going to be as larger economy than the U.S. The notion of investors avoiding the largest economy in the world, that's hard to fathom. So, but there's risk return on these decisions. So we talk to our clients about a portion of assets outside the U.S. in different instruments. And again, it goes all the way back to those private wealth teams that are at the heart of our advice to clients, talking to clients about the right levels of diversification on a geographic basis, on a liquid versus alternative basis, on a equity fixed income, the full range of decisions that go into a well-conceived investment plan.
As you evaluate risks around the world, and just to come back to China for a second, I've heard two very different schools of thought. One is basically the Chinese are committed to a form of capitalism. They want capital, they want investment. They're going to keep on that path. They're not going to really, over the long term, dissuade investors. Other people say, yes, that's true, but they also have other priorities that might get in the way of a typical investment. Which camp are you in, if either?
You know, the camp that I'm in there is not dissimilar from different countries around the world where there's geopolitical things that run through those economies. I mean, we're having a major discussion in this country about higher taxes. You have two parties that generally bring different views to that. And depending upon what happens from a tax standpoint here, that's going to have an impact on different parts of the corporate economy and potentially on markets. So that exists wherever you invest from a geopolitical standpoint. You know, the Chinese economy is now the world's second biggest and probably on its way to the biggest in a reasonably near-term scenario. So, we look at that and investors should be looking at the different risks that come with steps that the government...
Hard to pass it up. Hard to pass it up. I think it's fair to say. Greg Fleming of Rockefeller Capital Management, thank you so very much for being on Wall Street Week. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It is time now to take a look at next week on global Wall Street.
Thanks, David. The global semiconductor shortage and other supply chain troubles will be a major focus of US Vice President Kamala Harris's trip to Southeast Asia this week, where she also aims to shore up Washington's relations with countries at China's doorstep. The visit comes as the White House is debating the possibility of a free trade agreement with countries in the region, including here in Singapore and Vietnam, both on the Vice President's itinerary. We'll also get more clues on how Delta is derailing the overall global recovery when South Korea's early export data for August comes out, which the Bank of Korea will be watching closely ahead of their policy decision Thursday. Danny?
Thanks, Juliet. On Wednesday, the UK holds its 3-week review of travel restrictions, something the industry will be closely watching. And then on Thursday, we get a release of ECB minutes from their most recent meeting. Romaine?
Thanks, Danny. All eyes will be on the Federal Reserve policymakers who are set to gather for their annual symposium in Jackson Hole, Wyoming. Most members of the FOMC are expected to speak, including, of course, Fed Chair Jerome Powell. The market will be looking for any signal on when the central bank plans to start scaling back that stimulus. Meanwhile, lawmakers in the House of Representatives, they return to Washington, where Democratic Party leaders will try to work on a budget resolution that would help move forward a $3.5 trillion spending and tax package. Meanwhile, the corporate earnings season isn't quite over yet. Look for reports from software companies including Autodesk, Splunk, Workday, Intuit, and Palo Alto Networks. Also slated to report, fitness company Peloton, home builder Toll Brothers, and cosmetics retailer Ulta Beauty. David?
Thanks to Juliet, Danny, and Romaine. Coming up, sometimes the tortoise beats the hare. We talk with long-term value investor John Rogers of Ariel Investments about what the reflation trade means for value stocks and why bigger may not be better.
We would think it's a time for caution, a time for conservatism, and if you're going to be buying, to buy the value stocks that are still undervalued.
This is Wall Street Week on Bloomberg.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The growth versus value debate is a long-standing one, with mega-cap growth stocks hogging the spotlight in recent years, with the star power of names like Google and Tesla. The 5 largest components of the S&P 500 are Apple, Microsoft, Amazon, Facebook, and Alphabet.
We're
getting to a point where the rest of the market needs to participate. It can't be all about 5 or 10 names in the S&P 500.
Even though growth stocks have largely outperformed value stocks over the past few years, it didn't used to be that way. And value still has a place in long-term investing strategy.
These value stocks are still generally cheap and under-owned relative to growth stocks.
We see a mixture between deep value areas of the market, but also some of the more defensive growth parts of the market are starting to look quite attractive.
Economic conditions may be ripe for value. Bets on economic recovery bring the prospect of higher Treasury yields yet to come, which would tend to lift companies sensitive to the economy overall. A trend that began at the end of last year when the reflation trade lifted value stocks as the global economic recovery began to take shape.
The U.S. is a heavy growth market, and if you believe bond yields are going to edge higher, then growth stocks are going to take a little bit on the chin.
When it comes to value investing, no one knows it better or is perhaps more identified with it than John Rogers, co-CEO of Ariel Investments, with some $16.8 billion under management last time I counted. And we welcome John now to Wall Street Week. John, thank you so much for being with us. Let me start with the most basic questions here. We talk about value versus growth a lot, but when you take a look for value stocks, what are the criteria you use to say, yes, that's in the value bucket? What do you look at?
Well, first of all, we look at what we think is the way that we look at value is we want to have a low price earnings multiple, a low price to EBITDA multiple. And at the end of the day, we're looking for new companies that are selling at least a 40% discount to their intrinsic value, what we call our private market value. And we think that's critical to get it more than a 40% discount.
So let me understand that intrinsic value, because I've seen some debate now about how you define value. Some people would talk about price to book and say that actually that number is somewhat outmoded because tech has sort of changed the assets you keep on your balance sheet. Do you look at things like price to book or price to cash flow?
Well, we do look at price to cash flow for sure, but we also are, doing the traditional discount to present, discounting future cash flows into the future to get to what we would look at as our private market value. So that's something, people learn in business school, even though I didn't go to business school, but all of our analysts have, and they really do believe that, looking at those future cash flows, discounting them back is how you get to a real true value of a company.
So when you get to your bucket of, okay, these are value stocks, how do you discriminate among them and say, yeah, those are the ones that I think are really good investments for the future? Those may be value stocks, but I'm not so sure about them.
Well, one of the things we always borrow from our hero, Warren Buffett, we want to make sure that the company truly has a real moat around it so that 5 to 10 years from now, you can bet that that company's still going to be a leader in their field, and it will be hard for competitors to come and knock them off. That's really what we are trying so hard to understand, is making sure that industry is stable and that company's leadership role is going to be stable in the long run. Of course, we make mistakes, and so we want to make sure we have a margin of safety in case we're wrong. So we want to make sure the companies have a very, very strong balance sheet that can withstand all types of pressures that happen and that are inevitable as our economy goes up and down. And then finally, we're trying to look to a management team that we think is shareholder friendly, that cares deeply about their shareholders as well as their customers, as well as their employees. So getting to know managements is an important part of our research, going out and visiting companies, talking to management teams every quarter, understanding their strategy and their plans to win is an important part of our analysis.
John, I think one of the big changes, certainly since maybe 2008, maybe before, but I think since 2008, has been the role of government, first on the monetary side and then the fiscal side, in really involving themselves in the economy. I mean, some people have said the referee has now joined the game. Has that changed the calculus when it comes to value, when you know that you can have the massive, massive sort of fiscal and monetary stimulus?
Well, we think that has certainly made it very difficult over the last 12 to 13 years. You're right. Since the financial crisis, the Fed has injected so much liquidity into the market. They've kept interest rates historically low for a historic length of time, and that makes the value of growth stocks, look relatively cheap. The S&P at 21 times earnings is not overvalued if interest rates stay this low. But we do think inevitably all this stimulus has got to have an impact on inflation. And as we think about all the new things that are being contemplated now by government to throw even more resources at our economy, that ultimately, that's going to cause higher inflation, that will cause higher interest rates, and be a reason why growth stocks will start to underperform, because so much of their earnings power comes out into the future. And if you have higher rates, those future earnings are not worth as much today.
John, those of us in business and financial news like to think that we're providing information and helping people make better decisions with their investments. But I wonder if sometimes we might skew the system a bit. We tend to cover the really big ones. You know, when somebody goes over $1 trillion in market cap, boy, they get a lot of attention. Some people have balloons coming down and things. But talk to us about large versus small, because I think you have a somewhat different view about this.
Well, from the very beginning, when we started Ariel 38 years ago, we were heavily influenced by the place that I used to work, William Blair. You know, Mr. Blair used to always talk about the fact that smaller companies should be able to grow faster than larger companies. And we still believe that today. They can be more nimble. They can be able to take advantages of market opportunities when you're small and nimble. But secondly, smaller companies are less well-researched. They were less well-researched 40 years ago, and they're still less well-researched. They're not as well-followed. So you can find some inefficiencies in the small cap sector. And even today, the amount of research in the small cap sector, as you suggest, has gotten less and less and less. People are just not following these sort of neglected companies the way they follow the large growth companies that have been so popular, that are the multi-trillion-dollar companies. So you can do your own homework, do thorough research, and find these undiscovered gems, we think, in that small cap sector today more than ever. And that's why we continue to fish in that same fishing pond.
Do you have to be particularly diligent in that research on the debt structure? Because certainly I've seen reports that you have more zombie companies, people who don't generate enough cash to actually service their debt in the smaller cap companies. Is that true in your experience, and how do you avoid that?
There are a lot of frauds out there. There are a lot of companies that are hyped and have just great stories, but when you look behind the scenes, you know, the reality is not real. So one of the things we learned through the financial crisis is that we needed to create our own proprietary debt ratings. And Charlie Bobrinskoy, our vice chairman, heads up that effort, and making sure that we're not dependent on Moody's or S&P or any outside services. We're going to do that homework ourselves to make sure that company has the strong balance sheet to be able to withstand whatever things happen in our economy. So, but you have to be extra vigilant when you're working in these small companies, because they are susceptible to frauds and company managements that sometimes are telling a story that simply isn't true. So that's another reason why it's so important to visit with management teams, get on the plane, go and see people. During COVID, get on the Zooms and look people in the eye. Finally, we use a company called BIA Associates to help us ask better questions and help us to determine whether CEOs are answering honestly and ethically. We study their body language, we study the way they answer those questions, and we think it's just so important to be kind of an investigative reporter as we meet with these management teams to make sure we're getting the best information in the best way possible.
John, finally, we don't pick a lot of stocks on Wall Street Week, but I want you to pick one for us because I know it's a favorite of yours. That's Madison Square Garden, which is merged now back with originally the entertainment part of it. Give us a sense of why you think that's such a good stock, because it illustrates the larger points you're making, I think.
Well, Madison Square Garden Entertainment is extraordinarily cheap. We think it's selling at more than a 50% discount. And it's, you know, you think about it, it's an iconic brand. They own what's the greatest arena in the world in Madison Square Garden. And as the Delta variant eventually ends, people will be back in the Garden watching the Rangers, watching the Knicks, going to concerts. It's going to be an extraordinary business. They also control Radio City Music Hall and the Rockettes, which is worth a lot of money, the Chicago Theater here in Chicago. And equally importantly, they have made a major investment in Las Vegas in what's called the Sphere. We had a chance to go and visit the Sphere and have a hard hat tour. It's going to be a spectacular new arena with the best technology, the best sound system ever invented for concerts and special events in Vegas. It's cost over $1.8 billion. We think it's going to be transformative for the company. So you put together their traditional garden with their new arena and some of the other companies they own. We think it's just a terrific franchise, a terrific brand. And then finally, they own a lot of real estate in Midtown Manhattan. So if you believe that Manhattan is going to come back, Madison Square Garden Entertainment should benefit from that recovery.
John, just very quickly here at the end, we have a few seconds. Are you worried about COVID? Because all those things you just mentioned wouldn't be helped by COVID necessarily.
But we think inevitably COVID's going to be solved. You know, it's been a temporary, you know, it's this new recent Delta variant has been very scary, but it will end in a positive way. And so it could delay things a little bit, but the long-term story will be intact.
Okay, we can all hope for that. That's for darn sure. Okay, really appreciate you being with us, John. It's always a pleasure to talk to you. That's John Rogers of Ariel Investments, where he is co-CEO. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. We have a lot to go over this week with our special contributor, Larry Summers of Harvard. So, Larry, let's get right to it. The biggest story of the week, I think, on the headlines every single day was Afghanistan. It's a political, geopolitical, real crisis, I may say. Are there any economic ramifications, do you see?
Two comments, David. If this affects the broad perception of the administration, that could have economic consequences. If you look back to the fall of Saigon, no major economic consequences that followed that. And rather remarkably, a month and a half afterwards, the president's popularity was up by 10 points. Here's what people aren't paying attention to. The Taliban is going to find its victory very challenging. Afghanistan was an economy supported largely by foreign aid. That foreign aid, the U.S. spending from its troop presence, all of that is going to dry up. And that's going to make governing Afghanistan extremely difficult. And it may, a few months from now, be a source of leverage for people on the outside with respect to what happens there. They've got big economic challenges ahead, much larger than people are recognizing.
Larry, having been in Washington, take your first point. Do you think this puts some of President Biden's Build Back Better plan in jeopardy up on the Hill?
I think the linkages between foreign policy and domestic policy tend to be smaller than foreign policy people think. And, you know, it will all hinge on what happens over the next couple of weeks. And we've had a tough few days, and may well be the next few days are going to be even tougher. But if we are substantially successful with respect to the evacuations, and this doesn't dent the president's overall standing, I don't think the effect is going to be very large. If the president loses 10 approval points, all bets are off on his ability to move major legislation. But it's really an indirect effect through what it means for the president's approval, which is the coin of the realm in terms of presidential power.
Larry, another story in the news throughout the week has been COVID-19, the Delta variant, including now the recommendations about booster shots for people who are already fully vaccinated. You were one of the very first that I knew, at least, to spot this pandemic on the rise. Give us your sense about where we are in COVID, and specifically on booster shots, something we talked about last week on Wall Street Week, which is if we give the shots to booster shots, then what are we doing for the rest of the world that is not vaccinated at all?
Look, I think this is as clear a case as I've ever seen for where we need to shift from a policy of either or to a policy of both and. It is not remotely tenable for a U.S. president to heed the advice of the WHO that somehow he shouldn't do what he thinks is necessary for the health of American children and American seniors in order to vaccinate people abroad. That's not how countries operate. It's not how the United States will or should operate. On the other hand, there is no reason why we can't be launching big initiatives in tandem around both the booster shots at home and about supporting resilience capacity, exporting vaccines, and all that goes with responding to the pandemic. And so I'd like to see the United States be much more in the lead on the global effort at the same time that we're redoubling our efforts at home. I think that's the only way forward. If we pose this as a choice between American 8-year-olds and kids in developing countries and societies that are falling apart, that kind of hard-heartedness and hard-headedness will come back to haunt us for a very long time.
Larry, investors in the United States clearly were paying attention to China this week because China seems to be clamping down on yet another industry almost every day. We started with tech, and then we went on to things like media with reports they're going to clamp down on that. Now we're talking about cosmetics and liquor manufacturers. It's raising questions in some people's mind. Goldman Sachs said a lot of their customers are asking, is China investable at this point just because Beijing seems to be almost capricious?
Every investor will have to make their own judgment. Those who are serene about China remind me of those who are serene about inflation. Bad things keep happening, adverse surprises keep happening, and they keep explaining them in terms of specific factors and resisting the idea that there's some kind of emergent general pattern. And I think there is an emergent general pattern, not that China's going back to Mao, not that China's going to entirely renounce the market system, but I think the risks for foreign investors are going up and have to be going up at a time when the greater insertion of the Communist Party into every private enterprise is emerging as a very important priority for the Chinese government. So it's certainly a riskier environment, and I think that when you have a riskier environment, people demand much higher returns, and then there's a question as to whether, given the tensions between our nations, the much higher returns that are necessary to compensate for much greater risks are going to be politically sustainable for a long time in China. So I think anxiety is the right thing.
Larry, you and I have talked a lot about inflation over the weeks and even the months in past. This week, the head of the Norwegian Sovereign Wealth Fund, the largest in the world, told Bloomberg that he thought that the biggest risk for his portfolio on both the debt, the fixed income side, and on the equity side was inflation being greater than we thought. You've been concerned about inflation. Do you agree, though, that that's the largest risk for portfolios today?
It's the largest risk I can foresee. I've learned that more often what gets you is what you're not worried about than what gets you is what you were worried about. You know, all through the early part of this century, what people were worried about was the accumulation of U.S. foreign debt and a big U.S. trade deficit. And then when the financial crisis came, the dollar went up and our foreign indebtedness wasn't an important part of it. So often what gets you is the bullet you don't see, rather than the bullet you do see. But in terms of what I'm worried about, certainly inflation's got to be at the center of both inflation and the possible policy response to inflation and the emergence of a discouraging stagflationary sense. I think that's what people need to be very worried about. Right now, the markets are relatively serene on inflation, but we know that market psychology can change, and I always believe people should heed what I think of as Dornbusch's dictum after Rudy Dornbusch, a former teacher of mine who died tragically some years ago, that things take longer to happen than you think they will, and then they happen faster than you thought they could. And I think that's an important thing to think about with respect to inflation.
In conclusion, Larry, let's go through a rapid round, as Summer says here, and we'll do it a little bit differently. In 3 different topics, let's take a look at better or worse, 1 week out, 1 month out, 6 months out. Start with Afghanistan. Do you think 1 week, 1 month, 6 months out is going to be better or worse?
Worse, better.
Okay, 6 months out, you think it might get better?
Worse, better. 6 months out, I think that we're going to have more leverage than we realize, than people think we're going to have, as the challenge of governing Afghanistan is there for the Taliban, and they become dependent for various kinds of economic assistance on the rest of the world.
Okay, Afghanistan was number 1. Number 2 is COVID. Once again, 1 week out, 1 month out, 6 months out, better or worse?
About the same, worse, better. I think we're clearly in the midst of an upsurge from Delta, but I think the dynamics around vaccination will change. And I think as more and more people tragically are infected, more and more people will have a period of immunity. So I think we're going to be further down the road towards a new, somewhat unfortunate equilibrium where COVID is like a second flu, but is less paralyzing of society 6 months from now.
Okay, one more. The economy. Give us your read. 1 week out, 1 month out, 6 months out. Better or worse?
I think it's going to get more difficult. Combination of COVID, rising price pressures, financial markets that are priced for perfection. I don't think it gets much better from here anytime soon. We'll see some further reductions in unemployment, but I think the mood is probably going to get surlier pretty continuously over the next 6 months.
Okay, there you have it. That's what Summers says. Thank you so much to our special contributor, Larry Summers of Harvard. Coming up, one more thought. A legendary money manager tries his hand at Moneyball. This is Wall Street Week on Bloomberg. Finally, one more thought. Baseball as a science, or not. Steve Cohen made his name as an immensely successful hedge fund manager. So when he bought the New York Mets, no one thought he did it to lose, something he confirmed at his first news conference as owner.
I want an exceptional team. I want a team that's built to be great every year. I don't just want to get into the playoffs. I want to win a championship.
And for 3 months this season, it looked like Steve Cohen was going to get his wish as the Mets led the National League East. But then they had a bad road trip and dropped out of first to second and then to third, falling below 500. So Steve Cohen does what he does best. He applied the mathematical prowess that made him a billionaire, analyzed his team, and took to Twitter saying, quote, "It's hard to understand how professional hitters can be this unproductive. The best teams have a more disciplined approach. The slugging and OPS numbers don't lie." Now, for those of us who don't really follow baseball stats, OPS is a combination of on-base and slugging percentage. Mr. Cohen's rigor in analyzing his Mets brings back memories of Billy Beane in Moneyball, when he brought in a young economist to help remake his Oakland A's, after concluding that the only way they had to go was up.
There are rich teams and there are poor teams. Then there's 50 feet of crap. And then there's us.
And who knows? Maybe Mr. Cohen is on to something. Hours after he publicly called the Mets out, they came from behind to beat the Giants in extra innings, 12 innings to be precise. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.